Please take your seats. The program is about to begin. Please welcome to the stage Bloomberg Sonali Basak.
Welcome back, everybody. Ready for round two? I hope you enjoyed lunch, got to swap notes through it. We're looking forward to more conversations. Remember, there's Wi-Fi on your badges and on the screens here if you haven't already connected, and you can engage. If you're looking to connect further with the fellow attendees here, we have an event app. You can scan the QR code on our screens to download the Bizzabo app. And with it, you can access our virtual network community, and you can chat with other people who are here, build your agenda for the day, and remember to put push notifications on for reminders about the event throughout the day. And you can follow session highlights online on social media using the hashtag BloombergInvest or to tag us at Bloomberg Live on major social channels. And this is a good one. If you don't already subscribe to Bloomberg, you're going to want to pull out your phones, because for those of you in attendance today, you get a free 3-month subscription to Bloomberg.com. We love giving away free things sometimes, of course. Scan the QR code you see on the screen now for that. And, of course, it's a very big day here at Bloomberg with the new launch of Bloomberg Business Week, the cover story being with an exclusive with Bernard Arnault. I also want to take a moment now to give a very special thank you to our advisory board for Invest 2024. They have been with us throughout the way. Amazing, steering some great ideas for content and programming, and you'll be hearing from many of them on stage throughout the 2 days, including my next guest. We're going to get the program going again to talk more about the buzziest asset class on Wall Street. You've heard a little bit about it today already, and that is private credit. Please join me in welcoming John Zito, Partner and Deputy Chief Investment Officer for Credit at Apollo Global Management. John, some would say you have a large job these days.
Yeah.
So a few years ago, you talked about how you were pinching yourself amid the opportunity in credit markets, but the market has changed quite meaningfully since then. Not only have yields stayed high, interest rates have certainly stayed high. They're on the precipice of coming down. You also have a lot more entrants in the credit market. How do you think that the market has most changed in ways that people might not be seeing?
Yeah, well, thank you for bringing that up. Everyone at Apollo loves bringing up pinching myself, so it's always a fun one. The higher rates has really, for longer, has catalyzed a lot of things in fixed income. It's actually created this whole new asset class, whole new area that we can innovate and change the way that you actually access fixed income. That is where I'm spending most of my time. Clearly, private credit has gotten really popular. We weren't used to that. I was at Apollo for 10 years when no one wanted to take a meeting with the credit guy, really, right? In the last 2 years, our team has gotten a lot of attention. I think now it's, okay, rates may be up for longer than people expected. What does that mean for asset allocation? What does that mean for our investment businesses? Are we set up the right way to take advantage of what I think is going to be a completely different investment environment? And you look at things historically. In 1995, 94%, Callan Associates, 94% allocation to fixed income. 2022, the recommended allocation for a retiree, 3% to fixed income. Now they're going back to 51%. And it's all about, for us, it's all about educating on what private credit is, how do you access these mega trends that are happening in a really safe way, and how do you reverse what's gone on for the last 15 years, which is take an asset category and to get 8 or 9 or 10%, what'd you have to do? You had to go into all these complex strategies. You had to use leverage to get an 8, 9, 10% return. Now you can do it with a pretty simple loan. And so getting back to the basics of trying to solve what we have as a big retirement crisis and getting back to the basics of doing it in the simplest way possible, I think that's pretty exciting, but usually fixed income and excitement isn't in the same sentence.
So you look at, for example, where high yield spreads are trading today, and you wonder whether people are stretching for risk in this environment. Why do that when, as you say, you can extend a simple loan for double-digit returns?
Yeah, I mean, again, I think first step is, okay, what is private credit? Because there's a lot of definitions that are used for private credit. We define private credit as the $40 trillion asset class that is predominantly investment grade, that sits predominantly on bank and insurance company balance sheets. And in the context of that $40 trillion market, there's a sub-investment grade sponsor lending business, which is the historical lens of private credit. And that part of the ecosystem is going to have its business. We're really focused on we obviously do that business. We've done that business forever. For us, it's about how do we really solve the fixed income part of the balance sheet, and how do we have very different capital than anyone else in the market, and we have a DNA that's very different than anyone else in the market. Our DNA is totally integrated between equity and credit. It's to look up and down the capital structure and find the best risk reward. And our capital is super long dated. So it's set up specifically to service the mega spending that's going to happen in both energy transition and AI infrastructure, which is super long dated.
That AI infrastructure and energy transition, perhaps one example we saw of that recently was the deal you did, the joint venture, $11 billion joint venture with Intel.
Yeah.
How many deals like that are sitting out there in the ether? How big is that opportunity? It's an infrastructure play, after all.
Yeah, so between that and energy transition, it's multiple trillions of spending that has to happen. The unique elements of that are that they require both credit solutions and equity solutions, but in both cases require super long duration capital. And there are only few places that have the capital base that we do. Through our retirement business, through our insurance franchises, we can take 10, 15, 20-year type commitments, and we can approach things that historically have been approached through the traditional investment grade market and come up with solutions that are actually going to match any variable that's going into these new asset categories. There's going to be things that happen within the AI, what a company's going to need, what they're not going to need. They may think they need something today that they don't need later on. To be able to be a long-term capital provider that actually will flex within the needs of that company, what you're seeing is these companies partner with us. When we did InBev 4 years ago, we did a $3 billion financing for InBev. Everybody told me it was a one-off. There's no way S&P 500 companies with investment-grade balance sheets are going to access Apollo's balance sheet. And you flash forward to today, Air France, Vonovia, Intel, $11 billion. The size, the scale, the flexibility, the matching, it's actually been really fun. And I think the complexities of that, and actually we take all of our people, no matter where they sit in the organization, and we say, okay, take an Intel, let's solve the problem. Whereas when you think of an investment grade issuer, they're not used to being approached with a lot of different ways to solve a capital problem. And in this case, it was just getting really attractive, flexible financing.
So what does this mean? When I talk to folks at Apollo these days, investment grade is a term that comes up a lot, and it's not what you knew of the Apollo of the past. And you think about the market today in riskier debt financings, particularly when it comes to private equity. How interested are you in playing in that market? How troubled, frankly, is that market right now?
Look, I don't think, again, the private credit troubled for sponsor lending gets a lot of headlines, and I think it's a lot more around valuation below the debt. I don't think there's going to be one-offs, just like any high-returning sub-investment grade business. There will be mistakes that will get headlines, but in the broad scheme of things, I don't see tons of problems in that ecosystem. We're going to be in that business. We're going to be a leader in that business. There's a handful of us that have scaled pretty significantly. I think for us, it's more about how are we going to win over time, where it's not just a narrow sponsor lending business, but it's here are 20 products that we can offer your company. It may be an equity solution, it may be a debt solution, it may be an asset-backed loan or a corporate loan. And having the open architecture and having that DNA is something that just doesn't happen overnight. It's something we've been building for 15 years for our own balance sheet. It's just now that everybody's getting access to this through new products and new headlines. And because the returns are higher, now everybody wants access to it and is trying to get into it at the same time. And the question is, who's really paid the tuition to be able to service that quantum and that scale of opportunity?
Well, I'm going to jump ahead a little bit here because something I've always been fascinated about is, where does Apollo get their people? Where does Apollo get their talent? How do you put together that team that comes all together and finances that $11 billion transaction? How do you think about building the team, and how might it be different from, traditional Wall Street, frankly?
Yeah, look, the DNA, I grew up in the markets business, so I don't come down the traditional privates path. We have an amazing 35-year private equity business that grew up in the privates business. We have a private debt business. We have a public debt business. We have everything across, and we've typically recruited, and Apollo has had the ability to recruit people who want to get into complex, complicated type situations. I don't think a lot of them thought they'd be coming here to create solutions based for investment grade companies, but that's what they've become, And I think we just have a creative, public-private, flexible, adaptive culture that is hard to create if you have silos of, okay, here's your private credit person and here's your public credit person. It's a full ownership of being able to look at things from both risk and reward. And clearly, with rates going higher, it's really going to change the way you think about risk and reward, right? Because the last 15 years, to get a 9 or 10 or 12% return in real estate or infrastructure, what did you do? You bought a 5 or 6% unlevered asset, and you financed it with 2% debt or 3% debt. Now you're buying a 6% asset, but the cost of financing is 7 or 8. That math isn't going to work. You're going to have to look at things in a much more dynamic way, and we're positioned much better than most to make those decisions and have a framework. Our model, our mental model, and our framework to make those decisions because of the no walls is set up to win more in that.
Here's the thing, though, about higher interest rates. There's an expectation for at least one rate cut this year. Mm-hmm. If rates start to go down, how does that change the calculus of the business?
I mean, listen, the question is, where is the base? Where is terminal base? Where are we going to end? Is it going to be 3.5? What's the neutral rate? Is it 3.5? Is it 4.5? If you ask Summers, he'll tell you 4.5. If you ask others, he'll say 3.5. Either way, there were lots of assets that were purchased between 2018 and 21 when the assumption was that rates would be zero forever. And so in those cases, I think our business is going to thrive. Even in the low cases, I think, again, we were in that business for 15 years. We'll thrive and we'll adapt. But certainly in the situation right now, lots of that fund capital with the cost of financing doesn't really work. And you're going to have to be a bit more creative to actually find the solution.
What do you say to people who think private credit is in a bubble?
I say, what is private credit? Because, again, the idea that private credit is in a bubble and other asset categories that are either subordinated to the private credit is not in a bubble, that is a conversation, right? I think both things are not necessarily in a bubble. Lots of people, just like in any other rate hiking cycle, when cash flow was diverted to equity holders away from lenders for the last 15 years when rates were zero, clearly the better place to be in the capital structure was in the equity. You were effectively getting subsidized by very low rates and very low financing. The exact opposite is happening now. right? So we're now higher rates, most of the cash flow is going to the lender. And so clearly people will have to adjust how they invest the capital and where they sit in the capital structure.
To the extent that you do see cracks in the market, given that, to your point, there are a lot of people that have waited to refinance, where do you see the cracks?
Look, anybody who built their capital structure assuming that interest rates would be zero forever is going to need either new equity capital or some form of extension, and probably has too much debt today relative to what they anticipated for just regular way debt service. And so you're seeing it in the news episodically, deal by deal, deals that were done in 2018 to 2021, assuming rates would be low for longer, and they're having to restructure or bring in a pref or do some sort of equitization. There are 4,500 companies today that have been owned by private equity for over 5 years, or 1,200 companies today with the total market value of $4.5 trillion. So 1,200 companies, $4.5 trillion owned today by private equity over 5 years, which means that business, most of those companies are effectively for sale or need a solution or need to go into something. There are lots of ways to service that. You can provide new capital, you can provide refinancings to extend, you can provide a whole host of things on the equity business that can partner with the sponsor to extend that company. But servicing those 1,200 companies is a real thing, and it's close to $5 trillion of market value today, which, again, diversifying yourself across both credit and equity almost requires you to go into the private markets, and that is, at the core of what's happening in the overall landscape is just a lot more capital going from public to private.
You made this comment before about how a couple of years ago, everyone thought your $3 billion financing in regard to InBev was a one-off, and you're doing much more of them. Those financing used to go to the banks. When you think about today, there was, of course, a spate of regional bank failures. There was COVID. There are a lot of reasons that the banking industry has stepped back. We're on the precipice of potentially new capital rules, perhaps less onerous than initially sought after, but onerous nonetheless. Where does that leave you? If the banks are exiting certain parts of the market, where are you stepping in?
Yeah, look, I've been pretty clear. Every year I feel like the relationship actually with the banks is getting better. On Intel, there were banks that were advising the company, and that, just in normal course on almost all of our investment grade transactions, there is a bank advising the board or advising the company. It's more around who holds the asset and where is the appropriate place to lend long. And retirement products, insurance balance sheets with long dated liabilities, that is really about, we're just trying to make sure that we get, for a long dated solution, let's make sure it's in the appropriate place where you can actually maximize flexibility, maximize return, and create products that actually match to that. And I think we're in the early innings of innovating across lots of different ways to access. We have a generational asset transfer about to happen out of the banks. Longer duration assets will need to leave certain banks. There are ways to access that in different ways, either in partnership with the banks, but really getting it into retirees' accounts, getting it into retirement accounts to earn that extra 100 or 200 basis points of return, because that's what's ultimately going to solve the problem, right? The problem is we don't have enough savings and enough return. To earn that, it's small changes. Instead of making 5, let's make 7. How do we make 7? Just going a little bit less liquid, going a little bit long duration doesn't mean it's riskier. By making 7 instead of making 5, you may have double or triple the amount of retirement money in 20, 30, 40 years, depending on your time horizon, than you would have otherwise investing at 5 or 4.
The liability side is one thing. I'm still curious, though, about the asset side, because what else could you be investing in, very physically? If it's not investment grade debt, where else are the banks stepping back from the market because of regulatory reasons or otherwise that you find as new opportunities?
Yeah, again, things that are super long duration, like infrastructure, is a natural place that matches well with our capital. And again, for the banks are going to do a ton of services that we don't do. We care predominantly about the asset, and not so much necessarily about controlling the client with all these different services, cash management, treasury, other FX, other things like that.
The banks can have that.
Well, we want to work in partnership with them to make sure that they're getting everything that optimizes.
Are you considering a really big partnership then? I mean, you say partnership a few times today. Would you do a large partnership with a bank?
Again, for us, you've seen SRTs have been kind of the investment du jour for those
synthetic
of you
risk
synthetic. I was making it clear. Synthetic risk transfers, where effectively you buy and you provide first loss insurance in case there's losses, and that releases capital for a bank. We've done very few of those. What we've done is really work. We've done things like Atlas, where we buy Credit Suisse's securitized business, where it's strategic, it's long term, it actually services our origination ambition for the next 10, 20 years. It has to be really something that's going to work for both parties. There have been lots of partnerships that have been announced that have been small, narrow, and not, I don't think, fully diligenced with respect to how difficult it is to run those partnerships if there's not full alignment between the two parties. So, of course, we would entertain the appropriate partnerships, but they're very difficult to execute, and they need to be strategic given our size.
Now, in addition to the asset side, the liability side, as you've been talking about, for those of you that don't know, Apollo owns a massive insurance company. They merged with it a number of years ago, Athene. You could see it as the part of the retailization of private assets in some ways. How else are you looking to tap into individual accounts, to the wealth network?
Yeah, so we have our traditional wealth accounts. Mark's talked about potentially accessing through an ETF structure. I think you're going to see a whole host of innovation around how people access private markets, defining what private and public is. Can private be safe and risky, and can public be safe and risky? Going through that really explanation and understanding that if you're single A rated and you're private, it has the same rating by the same rating agencies as a public security that's single A rated. So I'm really excited about that. The ETF, which now is, I think, $9 trillion, was $2 trillion 7 years ago, was started in '93. It was not that long ago. And I think we'll look back at this time as really a time where there was a whole education process and a diversification and all the balances, and we're trying to be the leader in that, and doing it in a really thoughtful and balanced way, but also just trying to be innovative with an industry that typically has not had the focus, and higher interest rates have actually enabled us to really get everybody to focus on it a little bit more.
Before I let you go, last big opportunity. What is your biggest opportunity in the market today?
Single biggest opportunity is obviously, I think it's a combination of energy transition and AI infrastructure. It's strategic to all parts of the world. It requires trillions of spend. It requires trillions of spend on a long-dated basis. And I think we're just naturally the place to allocate that. And so I think we've positioned ourselves with both, you've seen us support some CHIPS Act supporters, right? Both Wolfspeed and Intel. And I think you'll continue to see us be a financing party for many companies in that ecosystem.
John, thank you so much. That is John Zito. He is the Deputy Chief Investment Officer of Credit at Apollo.
Please welcome to the stage U.S. Securities and Exchange Commission Chair Gary Gensler with Bloomberg's Anne-Marie Hordern.
Thank you so much for being here. Thank you, SEC Chair Gary Gensler, for
Glad
joining
to be with you,
Bloomberg.
Anne-Marie.
We're so excited to have you. I want to start with the uphill battle, some would say, you've faced at the helm of the SEC in terms of you have this very ambitious agenda, one of the most ambitious we've seen at the SEC in years, but it's faced a lot of legal troubles, pushback from Wall Street, corporate America. A stat here, as I have, is your rules are facing a record number of court challenges. So given that backdrop and the legal hurdles you faced, how would you grade this SEC? Is it an A for effort, or would you say it's a bit more?
Look, Anne-Marie, I'm proud to be in this role. It's a privilege every day to fight on behalf of Americans, investors, and issuers. And it's really that. It's like William O. Douglas, our third chair, and he went on to be on the Supreme Court, said we're the investor's advocate. But we also look out for people raising money, the issuers. The folks in the middle, some of whom are in this room, the broker-dealers, the stock exchanges, the investment advisors, and so forth, ultimately, the investors and issuers are their customers, and we are trying to update the rules for the 2020s. Now, we put out an agenda of about 50, 55 items to do. By the way, my predecessor, Jay Clayton, did 64. But we have already finalized and implemented really consequential rules, like in the last couple of weeks, implemented shortening the settlement cycle in half to 1 day from 2 days. That means if an investor sells their stock on a Monday, they get their cash Tuesday. They don't have to wait till Wednesday. But we also did a lot around corporate governance, how insiders sell their stock in the market, and some important rules there to restrict the use of non-public information, or even settling down some challenges that we had with China, and China being in our markets. And in the cyber world, that public companies have to report material cyber events, but also we just finalized a rule that all of us in this room, if our information at a broker-dealer or investment advisor gets hacked, they have to give us a notice on that. I mean, these are things that are consequential that we've been able to been successful. So I think it's a great agency, and we continue basically fighting on behalf of the American investor and American issuer.
So the most recent rebuke, though, came from the Fifth Court, which I think you know about, of course. Your attempt to regulate private equity funds and also protect private investors like pension funds. This is what the panel had to say from the court. Quote, it exceeded the statutory authority by adopting the rule. So now what's your next move? What's your response to this?
Well, one is we do everything within the law and how courts interpret the law. We're still assessing and looking at that ruling out of the Fifth Circuit down in Texas and Louisiana and Mississippi. And so we're still assessing that as a commission. But at its core, what we were really saying there was investors in private funds, which has grown to $30 trillion in assets under management. Investors in those funds, the limited partners, would get quarterly disclosures about their fees, performance, and arrangements with others, so-called side letters. And it was under authority that was put into law under Dodd-Frank. The court had a different view of that new authority, but we're still assessing what to do. But we do everything, again, Anne-Marie, within what the law is and how courts interpret it. And if need be, we pivot.
What are the risks to the financial system, say, that this doesn't happen and you're blocked for good?
At the core, what we were seeking to achieve as a commission was greater transparency to investors, not to the public, but to the investors in these funds. And who's behind those investors, those endowment funds, those pension funds? They're the teachers, they're the firefighters in every single state in the U.S. They're the universities' endowments that are investing in these funds. And so it was really about greater transparency, instilling greater competition in an important part of the capital markets.
This came from the Fifth Circuit. You mentioned Texas. A lot of these rebukes that are coming to the SEC are going through.
And to other agencies.
Right.
Across the administrative state, you're seeing more filings and in a couple of maybe leading in certain circuits.
Yeah, so what's your response to that? That a lot of this is happening through Texas, Louisiana. Does it feel political to you?
Well, we respond in whatever court we're in, and I deeply believe in our democracy. Parties have a right to go into court. we're a law enforcement agency. We bring 700 or 800 law enforcement actions a year, many of them settled, but some of them that go into court. And we really respect the courts and follow what they say.
We also have frozen right now the emissions disclosures, because that's also facing a ton of lawsuits. So the SEC decided to freeze them. What happens if they become unfrozen? How quickly do companies need to disclose these kind of emissions?
Just a little background. We're a disclosure agency. We're a securities agency, and what President Roosevelt pulled together with Congress 90 years ago, we just had our 90th birthday. It was kind of cool. And what they pulled together is that investors get to decide on what investments they want, and that we, the SEC, are merit neutral. Further, we are not a climate regulator. We are not an environmental regulator. We're not an ESG regulator. We're a securities regulator. But what we found when I came into office, many investors are investing in companies based on their climate risk disclosures. And of the top 1,000 market cap companies, the so-called Russell 1000, 90% already are making disclosures around climate risk, and nearly 60% are already making some disclosures around greenhouse gas emissions. That what you asked. Therein, I think we had a role, and what we finalized the rule to say, if material, it's only if material, investors would need to make those disclosures to their investors, because the investors are already making decisions on it. But you're right, it's front of a court. I'm not going to get ahead of our really terrific lawyers who will have a chance to lay out that in front of a court.
I guess the question I have is, will there be a timeline that companies will know that they need to start disclosing this? How quickly can you move with the rules once it's out of the courts?
Anne-Marie, it's a good question. Of course, it relates to what a court tells us. We laid out a set of it's called implementation timeline over a course of several years, depending upon what the court says. We did stay the rule, so that means it's stayed. But once we hear from the courts, I think you've got a good question.
So another place that you've been trying to tighten the rules.
Sorry if we didn't make news there.
Yeah, so it's okay. Maybe here we can. I know a lot of people are interested in this. There's a lot of messages when you tweeted that you were going to be doing this conference, a lot of messages from the crypto community. This is a place that you've tried to also tighten the rules.
$120 trillion capital markets, and lo and behold, I made it 6 minutes and 15 seconds, and now you bring up crypto.
Well, there's some other, other legal challenges.
I know it gets views, it gets clicks for Bloomberg.
Well, people are interested in this, and actually it's becoming a political issue. But I first want to talk about how do you reconcile broadly going after some of the issues in the industry, but at the same time as approving things like the Bitcoin ETF and potentially the Ethereum ETF.
So in terms of these exchange-traded products, any investor can express themselves and purchase Bitcoin, for instance. And when I came to the agency in 21, actually there were some filings around mutual funds, and they ultimately led to Bitcoin futures exchange-traded funds. Those have been around for 3 years. The courts ruled around something called spot exchange-traded products. I know it's kind of technical, but ruled that we should be consistent. We pivoted. We approved those in January. I would say this, what the investing public has now is an exchange-traded product on regulated stock exchanges. Now let me compare that to how people generally buy crypto. They're buying it or selling it often on non-compliant platforms. Why do I say non-compliant? These platforms also include significant number of tokens, and without prejudging any one of them, many of them are securities because it's the law of the land. We follow the Supreme Court's law of the land regarding this. There's 15 to 20,000 various tokens, and they're offered in investment contracts, schemes that are investment contracts. And you look at it, the American public is not getting the proper disclosure that they are required to get by law, but they need. We're merit neutral, but you all, if you're investing, if you're listening to the public, you're not getting the disclosure that you're supposed to get. And the intermediaries in the middle of the market, those so-called exchanges or broker-dealers and so forth, if they've got hundreds of offerings on that platform, think about it. How many of those offerings don't have some group of entrepreneurs in the middle? It just sort of belies logic. The result, this is a field that the leading lights from a couple years ago are either in jail, about to go to jail, or waiting extradition. Think about it. This is that field. That's the field right now where the public has really been harmed. And there's significant non-compliance in the field. And so, yes, we're bringing that in front of courts, and those will play out because folks that are not complying with the law hurt the American public.
But still, you're approving ETFs, and the one I think there's a lot of excitement around is this Ethereum ETF because we could potentially see it very soon. Will we see it? There
are actually, just so I can help you out, there, as of last year, was already an Ethereum exchange-traded fund based on Ethereum futures. Ethereum futures have been trading on the Chicago Mercantile Exchange for 3 or 4 years. We actually went live last year, an Ethereum futures ETF. But yes, we had filings around cash Ethereum exchange-traded products. Again, I apologize to be that technical, but these already exist in some form, but we approved those filings. What is in front of us, and it's done at a staff level, is what's called the registration statements, the disclosure statements. And again, these disclosures are really important. They're important to investors making investment decisions.
Will we see that in the next few weeks?
I don't know the timing, but it's going smoothly. You can almost follow it publicly. You see these filings. Bloomberg then reports on them. You get more clicks.
Do you think we'll see it before the election?
I'm not trying to determine what the staff is doing, but it's going smoothly, and I just envision it will at a staff level and smoothly play out. And it's really about the asset managers making the full disclosure so that those registration statements can go effective, and those lawyers know what that is. It's something our Division of Corporation Finance handles hundreds or if not thousands of times over anybody's career. It's smoothly functioning. It's really up to the asset managers to make the proper disclosures.
Back to some of the crypto companies, though. A lot of them have moved abroad to places like London and Singapore. So in that sense, do you think that investors are actually safe? Because they're still innovating, and they're still out there in the marketplace. They're just not in the United States.
To the extent that they're operating within the basic protections of providing the full disclosure, what Roosevelt called complete disclosure. He called the first Securities Act the Truth in Securities Act. If they're really telling the truth about it and they're making the disclosures and properly registered, and then if the intermediaries are operating within the law without the conflicts, and look, so much of this field is highly centralized. It's not decentralized. That's not what's happening here. It's highly centralized around a few platforms that are also centralizing and commingling things that we would never allow anywhere else. And we don't. The law doesn't allow you to be trading against your customers and operating a so-called exchange and trading in front and possibly also taking investments in a investment contract or security and then listing and getting the listing pop. I mean, these are all happening potentially at these. And again, we see some of the leading, 2 years ago that would have filled a room much bigger than this if they were sitting on this stage are now sitting in jail or awaiting jail.
Part of the reason why
I say this and you giggle, but this is a serious thing. These are a lot of folks that are not living within our securities laws. but they're not necessarily living within our Bank Secrecy Act around anti-money laundering. And they're not necessarily living within the Commodity Exchange Act. Like, this is a field that's sort of built up on a business model that it's a non-compliant model. And it's not ticky-tacky. It's about real protections for investors and for other people that want to access the capital markets. It's about trust in those capital markets.
As you know.
Have I been clear?
Yeah, you're being very clear. As you know, crypto, though, is becoming almost an election issue. There's reports that former President Trump is going to speak at this big Bitcoin conference. He said that he will end, quote, Joe Biden's war on crypto. And there's one more. It's become such a big deal that Mark Cuban has actually said that you, Mr. Gensler, could, quote, literally cost Joe Biden the election. What's your response to this?
I'm going to be easy with you, Anne Marie. I don't speak about elections.
You don't have a response to Mr. Cuban?
I don't. Really, look, my role as a securities regulator, as chair of this great 5,000-person agency that oversees $120 trillion capital markets, we are here to look out for investors, look out for issuers, and where appropriate, to be a cop on the beat. And we have a set of rules that are pretty clear. There's nothing inconsistent about crypto securities and the securities laws. Unfortunately, there's a number of people that are non-compliant with the laws.
Let me ask it a different way. Are you surprised by the political movement we've seen around crypto?
I'm a securities regulator. I'm focused every day on that part of my job, which is protecting the investors, looking out for issuers, access to markets, fair, orderly, and efficient markets. And with all respect, I hope your listeners understand that's my role. Other people can speak about elections.
So the election is coming up, though, and although your term
Anne Marie,
although your term
take three.
Although your term goes beyond November 5th, is there something you want to get done? Do you feel like you're up against the clock to get something done before the presidential election?
Look, it's such a privilege to be in this role. I really mean it. I can't believe I'm serving my third president and been through Senate confirmation 6 times and all this. I just can't believe that. And every day, I think, is a privilege to help the American public. Our clients, 330 million Americans. It's about chasing down insider trading. It's about making sure that there's the proper disclosures. It's about implementing. We still have some significant things. We just implemented this big transition to having the clearance, the settlement cycle to 1 day. But we're also working on the implementation of our Treasury clearing rules. And our $27 trillion Treasury market is way too jittery. It has fragility and jitters in it every couple of years, and settling that down and sort of implementing that set of rules. But yes, there are still some rules that we proposed and we have not yet adopted that we're working on, but we're not doing it against a clock. We are basically trying to promote these markets, enhance these markets on behalf of the American public. And if I've honored to serve through my term, which is through 26, great. If it's earlier, that's democracy. Democracy in action. And I deeply believe in it, but we're going to do everything we can for the American public.
I guess what you're insinuating there is that if we were to see a Trump 2.0, you likely would potentially be out of a job. Election or not, timelines or not, what is your number one priority at this moment?
It's my number one priority is the American public. That's the client. And so that's who we represent. It's, of course, implementing some of the rules that we've already adopted. It's considering the public feedback on the rules we propose and not adopted, but not against a clock. It's your clock.
Well, it might be yours.
You kind of run the field as well as you can run the field, and when the ref calls the clock, you see where you are. I just with all respect. And of course, it's also being a cop on the beat. You know, half of our agency is examination and enforcement. Another 10 or 15% of our workforce reviews all these disclosure filings and gives feedback to the issuing public. And it's doing that well.
SEC Chairman Gary Gensler, thank you so much for your time.
Thanks, Anne Marie.
Please welcome to the stage Bloomberg's Michelle Lynn.
Hi there. I'm Michelle Lynn, Global Head of Data Science and Insight for the Bloomberg Media Organization. That was a great session. I hope everyone is enjoying the programming. I am back to conduct the second poll with question crafted by our participating sponsor of Bloomberg Invest, Southern Company. If everyone could take out their phone and scan the QR code, whether you are virtual or in the room, we would love to hear from you. Before we hear from Gina Martin-Adams in 1 minute, we'd love to just do another polling question. So the question created by Southern Company is, based on what you know about the clean energy transition, when should public and private sector industries achieve net zero operations? Please scan the code now. You should see a polling icon in the bottom right-hand corner that will let you choose your option. And the options are today, in 2030, in 2050, or other. Based on what you know about the clean energy transition, when should public and private sector industries achieve net zero operations? All right, we're getting some data in. All right, looks like the majority, we will get to over 50%, 2050. 36% are saying other. 9% are saying 2023. Oh, that got to 10%. And about 6% are saying today. Thank you all for participating in our poll, and thank you to Southern Company for such a great polling question.
Please welcome to the stage Bloomberg Intelligence's Gina Martin-Adams.
Okay. Good afternoon, everybody. Don't leave. Please stay. We only have 10 minutes to talk about the equity market bubble. It's not long. I'm Gina Martin-Adams. I'm the Chief Equity Strategist for Bloomberg Intelligence. Those of you that are not familiar with Bloomberg Intelligence, we are one of 3 research divisions inside the Bloomberg terminal. I'm thrilled to be with you here today to just spend 10 minutes or so talking about the equity markets. And hopefully we'll answer the question that I think is on everyone's mind. Are we in a tech bubble 2.0 or no? So let's just go ahead and get started. If I can have some control. There we go. Here's Bloomberg Intelligence. We are one of the research divisions inside Bloomberg. We cover just about everything you could possibly want to know about stocks, bonds, equity markets, credit markets, commodities, currencies, regulatory litigation factors, ESG. Please visit us at Bloomberg Intelligence BIGO on your terminal. We are here today to really talk about the equity market just for the next few minutes. Tech Bubble 2.0. I want to go through 3 different and key differences between today and 1999. I think really since the year 2000, we've been in this permanent era of concern about the next bubble emerging. Of course, with NVIDIA stock really surging, AI themes leading the markets over the course of the last 2 years, we've been in a new round of this concern. But there are some very, very big differences between the markets today and those of 1999. Not all of these will shelter us from all of the risk that is naturally evident when we are investing in equities, but there are key differences. The first we'll go through is market sentiment. I don't know about you, but my view of the equity market is that excitement about stocks seems pretty benign relative to the excitement that existed in 1999. We'll go through some price charts as well as our own proprietary indicators of sentiment to discuss that framework. The fundamental landscape is also incredibly different today than it was in 1999. Valuations show that enthusiasm for stocks, to the degree there is any enthusiasm, is really backed by earnings, which was certainly not the case in the late 1990s. And then last but not least, tech's market share may be the biggest risk to watch. Certainly we've talked about this a lot, but even coming into the last 2 years, tech and tech-adjacent industries were an enormous portion of the equity markets, which does create some degree of risk that we should acknowledge. Okay, if we move on to the first slide, I hope, we can see, is this another equity market bubble? This chart shows you, of the last century, what I think most people popularly consider to be the 4 biggest bull markets. The 1980s and 1990s, which is the blue line, the last 5 years of that bull market is the blue line on this chart. The yellow line is the 1920s, the late 1920s, the roaring 20s, the last 5 years of that bubble. The green line is the 1963 to 1968 period, 1950s, 1960s, was certainly a pretty strong and long bull market. Many don't consider that to be particularly bubbly, but nonetheless, it was a very long bull market of the last century. And then the yellow line, the pink line, is today. The last 5 years of equity market returns clearly do not quite look as excessive as those that existed in the late 1990s or the 1920s, are marching to the beat of their own drum, more consistent with the bull market period of the 1960s. Our Market Pulse Sentiment Gauge, which is our own proprietary indicator that we developed to really gauge the sentiment of the equity market itself, also suggests that we may be approaching a manic kind of environment, but we haven't touched mania. As a matter of fact, the last time we touched mania, exhibited on the graph on the right, was back in 2021. You could see we hit the panic button back in the fourth quarter of 2022. Indeed, the panic evident in the equity market by October of 2022 was equivalent to the panic evident in the equity market at the lows in 2011, 2016, as well as 2009 by our measure. And we have yet to really exceed any kind of mania or reach any kind of mania in the period since. The red line makes mania for us in our indicators. So we have yet to reach any kind of mania. In terms of the broad market at large, I think one of the things that we really want to consider, if we could go to the next slide, is what's happening with valuations. And as you can see, valuations today also look very different than valuations looked in the last several decades. On the left, you can see the equal weighted index for the S&P 500, certainly not looking very bubbly as it did in 2021. On the right side, you can see the difference between the most expensive and the least expensive stocks in the S&P 500 index, also not particularly bubbly. This spread reaches at least 4 times in bubble periods, as it did in 2000 and in 2021. If anything, valuations are telling us that we had a bubble. It burst in 2021, just like the 2000 bubble burst as well. If we're to move to the next slide, please. Of course, everyone wants to point, though, to what's happened with NVIDIA, compare it to Cisco in the year 2000, and say, we're in a market bubble. There does appear to be at least one stock that investors are interested in. As evidenced by this graph, the price ascension over the last year that we've witnessed for NVIDIA is very close to the price ascension that we saw in the last year of the bubble for Cisco. However, if we move to the next slide, we can see one very significant difference is that valuations for Cisco in the final year of its ascension, and indeed in the final 3 years of Cisco's ascension, only accelerated very rapidly, whereas valuations for NVIDIA actually have contracted over the last 1 year and 3 years, respectively. We see this similar phenomenon evidenced in the broader equity markets. On the next slide, we can see that tech specifically also shows valuation spreads peaked back in 2021, certainly not at levels that were existent in the tech bubble, but valuation spreads at roughly 3 times. When we look at the most expensive tech stocks and we compare those to the cheapest tech stocks in the market, do not look particularly bubbly. On the right exhibit, you can see those most expensive stocks. The median valuation currently sits at about 40 times earnings. Back in the peak of the tech bubble, we were looking at 120 times earnings for the most expensive tech stocks in the market. So clearly a pretty significant difference. We'll go to the next slide, please. And the big difference is, of course, that the tech sector has earnings today, whereas it really didn't have a whole lot of earnings growth in 1999. This chart shows you the percentage of the S&P 500 tech sector with less than $1 in EPS. In 1999, 2000, the yellow bar on this graph, it was more than half of the tech sector had less than $1 in EPS. Today, that number we just updated it this week is 5%. So clearly there is an earnings framework, earnings difference this time around. Next slide, please. And indeed, we see that one of the reasons why there is so much optimism evident in tech, evident in NVIDIA stock, so much price ascension in that group, so much concentration risk that has emerged is because we also have earnings concentration. Tech and AI industries at large have been the only sources of growth from a fundamental perspective. And that has underpinned this optimism that has emerged in prices. As you can see on the chart on the left, the Mag 7 growth rate for earnings. Mag 7 were the only stocks actually producing earnings growth in the market. Mag 7 earnings were contracting right up until last quarter. This quarter that we're about to get reports on in July and August will be the first quarter in 6 in which Mag 7 stocks are expected to produce earnings growth. Likewise, the chart on the right shows you tech and communications stocks earnings growth trends compared to ex-tech and communications. And you can see that ex-tech and communications, the broad market, was in an earnings recession up until this year, where we're expected to see some shift. We'll go to the next slide, please. And as a matter of fact, when we look at the share of earnings growth, we can see very clearly that in 1997 through 1999, tech was just barely contributing to earnings growth on the S&P 500. We do our own definition of artificial intelligence firms. These are all the companies in the S&P 500 with exposure to artificial intelligence. They number about 40. You can see that artificial intelligence firms at large have contributed all of the earnings growth for the S&P 500 over the course of the last 2 years. So no wonder, then, that all of our hopes and dreams are concentrated in these sectors. Let's move to the next slide. Luckily for us, and hopefully this does occur, the consensus is telling us that this will change in the second half of this year and into 2025. And if this does, we should see the broadening of optimism into other groups inside the index. We may see some stall in the biggest stocks' performance as their earnings growth rates decelerate, as their contribution to earnings growth is no longer so significant. But as you can see in this graph, when we look quarter to quarter to quarter, we've contended with a major earnings recession for 3 different sectors: energy, healthcare, and materials. That's the green, blue, and gray bars on this graph. Those recessions are anticipated to end over the course of the next year. By the first quarter of 2025, we will have the first quarter since 2022 in which all major sectors for the S&P 500 will be contributing to earnings growth. That should be pretty consequential for rotation. Now, where's the big risk? The big risk is, of course, still in concentration. If we don't get this rotation as tech earnings growth decelerates from this rapid pace, where do we go from here? Let's go to the next slide. Tech is a gigantic part of the market, not only in the US, but globally. Before this advent of the AI phenomenon really started to impact earnings trends, AI share of market cap was enormous. Tech's share of market cap was significantly larger than it was in 1999. Hence the fear. We're very dependent upon tech in order to operate. Notably, if you go back to the corrections in the equity market in 2018 as well as 2022, 2 big corrections, both were signaled by tech earnings reports. Both were signaled by Meta telling us that they were going to have to either spend too much or they weren't going to quite make numbers going into the next year. So tech is having an enormous impact on sentiment as well as performance. Next chart shows you this is not just a U.S. phenomenon either. Market distortions are global. So while we think of this as a very U.S.-centric story, indeed 40 of the names in our universe of AI stocks, which number about 89, 40 of those names are U.S. companies. So it is a U.S. phenomenon, but it also is a global phenomenon. If you look at, for instance, the market distortion in Taiwan or Korea, even Europe has some market distortion because of AI. And Europe doesn't have a whole lot of tech stocks. And as you can see, it's distorting our indices as well. When you exclude the impact of AI, you see a very big difference in market returns. And artificial intelligence in particular has driven global earnings as well. So when we look at what's driving global earnings trends, it has been artificial intelligence firms, where the earnings outlook for artificial intelligence firms has been improving all year. The earnings outlook outside of artificial intelligence has actually been deteriorating. This does create some risk for us in the short term. We'll move to my final slide. That's all I have on the tech bubble today. Please visit us for more information on the equity market outlook. You can contact us at any time on your terminal. My page is at BI_STOXGO. We have a lot of interactive events. We're actually having a webinar coming up on Thursday where we'll dig into this topic, as well as sector and factor strategy for the U.S., and we're happy to take your call at any point in time. So please do reach out if we can help with anything. I think that's my cue to go. So thank you so much for your time today.
Please welcome to the stage Cliff Asness, founder and chief investment officer at AQR Capital Management, with Bloomberg's Shonali Bassick.
That was a pretty perfect setup for our next guest. You may know Cliff Asness, of course, the founder of AQR Capital Management. And, you know, you might have seen the title of this part of the program, Has the Market Gone Awry? And in addition to, of course, being a high-flying hedge fund in Greenwich, Connecticut, you're known at AQR for being quite nerdy, let's say. You are very much coming out of the school
Not just at AQR, since middle school.
So let's put it this way. Out of the School of University of Chicago, under Eugene Fama, studying efficient market theory, the question is, do you think the markets are still efficient?
I took Gene's class, and then I was the teaching assistant for 2 years. And I was terrified to get something wrong, so I sat through it for 3 years. About the third week of class, he looks and he tells the students, the market is almost certainly not perfectly efficient. And you get a big gasp. Now, only at the University of Chicago and only Gene's class do you get a gasp with that. Everywhere else in the world, people either go, yeah, we know markets aren't perfectly efficient, or they have no idea what you're talking about, which is often quite common. What he meant, he's an honest guy. He believes they're more efficient probably than I do now, but perfect efficiency is silly. Nothing is perfect. The question becomes, how efficient are they? I think it's fair to say someone like Gene thinks they're pretty darn efficient. Efficient is this idea that prices are accurately reflecting fundamentals. You can get really geeky on how to define that, but let's just be colloquial. I do have a view, it's not a short-term view, it's not a market call, that, again, markets are never perfectly efficient, but over my career, which is annoyingly about 32 years now, I guess the opposite would be even more annoying, but it's a long time. I'm a little obsessed these days with those internet memes of when they show you like an actor like Ed Asner and Mary Tyler Moore was 10 years younger than me when he did the role. It's very upsetting. But over my career, I actually think markets have gotten somewhat less efficient, meaning prices are a little bit more disconnected from reality. It ebbs and flows. It's never the same at each point in time. But I find that an odd view because one tends to think, as technology in particular advances, that things should march towards better, with better, I think, being efficiency in this case. And I actually think maybe I'm biased by having a front row seat, but I think over the last 30 or so years, I'd say the market is somewhat less efficient than when I started.
So why do you say that is? What is causing it to be that way?
It's, well, first I start out by just observing a few facts. And I am, of course, biased by what I've lived through, but I loved Gina's presentation. The dot-com bubble stuff was bringing, PTSD-like memories for me. We try to very formally measure how disconnected from reality, or not, or how reasonable our stock prices, in particular, not the price of the whole market, but within the stock market, are cheap versus expensive stocks. You could define that very narrowly in a quant sense in terms of just multiples. You could define it more broadly in terms of a Graham and Dodd sense. Yeah, you want to pay a low multiple, but what's the quality of the stock? What's the risk of the stock? But either way, measured very formally, the dot-com bubble saw by far the largest disparity between cheap and expensive we had ever seen in about 50 years of data. We survived that. It was a little ugly for a while, but we actually thrived through it if you take the whole round trip. But when you almost die in the first half, you tend to remember that. If you had asked me in, say, 2002, when all of that excess was pretty much worked off, are you going to see something more extreme than that in your career? I think I'm smart enough, even back then, to never say never. We don't live in a business where any of us should say never. It's a dangerous word. But I think I would have said it's highly unlikely. That was the craziest thing we had seen in 50 years. I would have said, well, in 20 years, people like me will still be around, I hope, with some memory. It's not 100 years where everyone is forgotten. And then pre-COVID, it was close. And then after COVID hitting, we saw things measured very similarly. Price multiples or even price multiples scaled by quality to go to levels well beyond the tech bubble and lasting about doubly as long as the tech bubble. If you ever have the misfortune to have an investment that ever goes down for any amount of time, you will learn something that they don't teach you in a PhD program. Severity is bad, but duration is underrated when it comes to pain. 3 years of pain, even if it's cumulatively not worse than a year and a half of pain, is a ton worse. The first year you go back to your clients and go, we think we're right, look what's going on here. They go, okay. The second year they're like, that's the same thing you said a year ago. And you go, yeah, but it's still going on and we're still going to be right. The third year, your mom's still invested, but it's getting tougher. So duration counts. So we've seen both the severity and the duration of those. So I start out just observing facts. And then trying to fill in why. Admittedly, this is a lot of op-ed. This is very hard to prove. And I love to, I'm a card-carrying quant. I love to, produce tables. I can show you these spreads, but why? And I tend to I think it's a multitude of things. I think the number one thing is probably the thing we all love to blame, the internet and social media. I think a lot of people naturally assume such a thing would bring us information so quickly and so ubiquitously, knowing everything, that prices would be very efficient. But that's never been the hard part. When I started in this industry, we got earnings within 20 minutes. The difference between 20 minutes and a nanosecond matters to an HFT. It doesn't matter to almost every other investor. We didn't really materially get more. And I do think that level of information overload gives people a lot of illusion of control. I don't want to go into this deeply because I know you'd like to get me going on this, but I think the meme stock examples, I don't think they're the norm by any means, but I think they're the ultimate example of a little bit of information making you think you really know something very deeply, and I think that gets into market prices.
I'll be careful to keep this a little reined in, but on the meme stock issue.
I knew I'd get that started.
How much are the retail traders that are bidding up prices of stocks like GameStop contributing to this idea that markets are less efficient to you?
I think they are a very small part in dollars. They may be poster children in some sense for the effect. The whole idea that this disconnect in prices can come in a world where we have all the information at our fingertips. I think we're all raised, at some point we've all read about the, quote, wisdom of crowds, the way, if you take a crowd that on average people have 51% information, but you poll them. Hope many of us here are old enough to remember Regis Philbin and Who Wants to Be a Millionaire? The absolute best lifeline was always poll the crowd, right? Because if they asked a question, what does it say on the back of a quarter? 85% of the people don't know. But they're evenly split. And the 15% who do know all go one way. But there was always a little unspoken footnote to the wisdom of crowds. to have a wise crowd, it's got to be fairly independent. If everyone got to talk about the quarter, not look at a quarter, that's cheating, but talk about it, the people who are wrong convince the people who are right and whatnot. A crowd where everyone is coordinated and not independent has the risk of becoming a dangerous mob. And I don't know about you guys, but I can't think of anything better at turning a wise, independent crowd into a dangerous mob than the internet and social media. So I do think they're kind of the poster child. I don't think economically they are that important. I don't want to disparage either side of it, but it's $9 in terms of, NVIDIA laughs at that on a daily basis. The entire meme stock phenomenon is like a little part of a day of NVIDIA. But I think it is a poster child for the concept I'm talking about. There are other candidates. People talk about the role of passive. That's really complicated. I'm not one who just looks at passive and goes, that's causing all kinds of havoc.
What is it causing?
Okay, I'll disappoint you here. People, I don't think we really quite know yet. First of all, here are the things we know about passive. Not everyone can be passive. The whole world breaks down. Even back when I was a PhD student, so this is the early 90s, this is what happens when PhD students in finance get drunk late at night. They sit around going, what if everybody tried to be passive? And that's a black hole. That's a singularity in finance. Nobody's looking at individual stocks. And that just can't work. Passive is a free rider on active managers, making sure prices are somewhat reasonable. But the question of how many people can be passive, nobody really knows.
Do you think it's contributing to inefficiency? And is efficiency, frankly, another way of saying wild swings in markets?
I think I would guess yes, but I think it's pretty small versus the social media, the illusion of control, the data overload things I'm talking about. It's not clear theoretically. Imagine you had a world where you had a certain amount of passive and active, and suddenly a lot of active moved to passive. Whether active is now easier or harder, whether it's more or less efficient, depends on who moved. Let me be really obnoxious and go, there were sharks and minnows. There were people who were good at it and people who were bad. If all the minnows move, markets get really efficient because sharks are trading with sharks. They all are pretty good at valuing these things. And the sharks don't make a lot of money. We don't really know who moved. My reasoning here is really just correlation, not causation. This has occurred at the same time that massive price disparities have grown and lasted longer. So as a pure guess, I would have to go, it's probably contributed something. It's very hard to assign. Another one is, I'm probably the billionth person to mention this, but over the same period, we've had 10 years prior to a couple of years ago of ultra-low nominal and real interest rates. I am not a person who thinks that means growth stocks should go to the moon. I've written papers on the math of that's kind of wrong. They're not actually that much longer duration. But the market disagrees with me. The market thinks when interest rates fall, growth stocks should go to the moon. And so ultra-low interest rates have probably contributed to a fair amount of that also. So I think it's a witch's brew, but if I had to put the three, I think maybe I'm just an old man ranting at TikTok, but I think the feeling that you own all the information and are on a level playing field, and therefore you can own two stocks and be very confident about it, is probably my number one thing to point at.
So let's step back for a minute, because you were concerned about the efficiency of markets here, and we asked, has the market gone awry? Has something about the market broken to you?
Broken's such an ugly word. These are points on a spectrum. For me, broken is very, I'm going to define that as are we in a bubble or the opposite of a bubble, an irrational depression, where people won't pay any fair amount for stronger companies or whatnot. A bubble is when we look at the companies people like and they're willing to pay giantly excessive amounts. So let's say bubble and broken are equivalent. I use the word bubble, I think, less than a lot in the industry. I once wrote a sarcastic piece. Really doesn't narrow it down amongst the pieces I've written. But making fun of the term bubble, that on the extended use of the word Wall Street, a lot of people will see bubbles everywhere. And they translate it a little too weakly as a bubble means a stock I kind of don't like. No, that's not a bubble. A bubble, to me, is a vastly diversified set of things that I cannot come up with any reasonable assumptions that could possibly make these valuations work. I have seen two in my career that I think we identified before the fact, and one I was a passive watcher of. The dot-com bubble, which again, the PTSD from the earlier presentation, and then really 19 and 20, when stocks surpassed I would use the word bubble for that. Since then, the way we measure value, and everybody who measures it's one of the hard parts of communication in this world is everyone's going to measure it a little differently, but the way we measure value, we've come in from the new 100th percentile, which was set in the late 2020 period. Sometimes I jokingly call that the 130th percentile, and I wait to see if people think that's reasonable. Then I like to gauge the math level of the audience in those sneaky ways. So the new 100th percentile, which is about 30% more than the old one, that I would certainly call a bubble. I don't think there were any assumptions you could have come up with. We define value as relatively pretty strongly industry hedged, very apples to apples, epic differences in valuations. Right now, after about 3.5, 4 years about 3.5 strong years for the way we define value, that spread is down to the 80th percentile. I don't call 80th percentile a bubble. And 80th can go back to 90th in a heartbeat. There's nothing that means it's going to be a smooth path. I have downgraded value investing in general. You look surprised. I'm not a perma value guy.
We're going to bring the audience in actually here because that's our polling question. And while we have Cliff answer the value thing, you're teasing it already.
Well, I've downgraded it.
Does value investing still have room to run?
Well, the answer is still going to be yes, because I've downgraded it to something we like on average when it's 50th percentile. We want that as part of what we do, meaning all else equal, we prefer to pay a lower multiple. I don't know when we ever wouldn't. At 80th percentile, we do think it's more attractive than normal. So yeah, by that definition, we do think there's more room to run, but it's not an arbitrage you can drive a truck through. In late 2020, if I may be bold, the challenge was not being right. That was relatively easy. What was going on, I think, was crazy. The challenge was surviving being right. That can be hard. I think right now at the 80th percentile, yeah, you want this as part of your portfolio. Maybe you want a little more than normal, but it's not the opportunity of a lifetime, which it was 3 years ago. If someone is constantly telling you the same trade is the opportunity of a lifetime, you probably want to run.
So speaking of opportunities of a lifetime, a couple years ago, very recently, you've been hitting records at AQR. A number of your funds have just been performing like they've never performed before. Part of that was the value trade.
Actually, less than you would think, but a decent part of it.
Well, what's contributing to it? Because even through the first quarter of this year, many of AQR's major funds were up double-digit percentage points. And what is it exactly that you're doing differently at AQR now than you were before?
There are definitely some things we're doing differently, and I will answer you. Some of it is the fact that if you do the same thing consistently over time, and it is a good thing that works over the long term, sometimes it works for a few years and sometimes it really doesn't. So you can have those kind of streaks without doing something differently. I get very leery of talking about this because the very rough 19 and 20 was a very small contributor to changes we made to the process. We're always trying to make change. We're always trying to get better. Who in the industry is not trying to get better? I think we got a lot better at how we allocate among these geeky equity factors. We've gotten a lot more systematic. For our first 20 or so years, it was probably me and a handful of people saying, what's a reasonable long-term allocation? And we stuck to it. Not to get into an AI kind of theme, but we let the machine decide more. And it took me a while. I probably slowed us down 2 years on this because I think it's my job as an old man at the firm to kind of say, you're going to change to what? But I'm reasonably convinced it's just at least a little bit better than us. So I think that's better. Some of the things we do that we haven't discussed in the world of trend following, I think we've taken a huge leap. And we did price trends since I wrote my dissertation. in the late 80s and early 90s. 1990s, not 1980, not 1880s, but a while ago. But in the last 5 years, tremendous weight, not just to price, which it was historically, but to fundamental trends. Tremendous exposure to more esoteric trends than just your famous stocks, bonds, currencies, and commodities.
What?
Suddenly, I'm walking around and somebody is talking about trading milk. And somebody's talking about trading sugar. And somebody's talking about trading my favorite, Malaysian palm oil. Please don't ask me if we're long or short Malaysian palm oil. I don't take an interest to that level. But I do take an interest in the fact that we trade it. And we found the sweat equity of pushing into newer markets. They're smaller capacity, in basic value investing around the world. And value in a broader sense than just quant multiples, considering quality, more of a Graham and Dodd sense. You can run an awfully lot of money in that. And I think it works. The challenge is it will have its very rough periods in sticking with it. Esoteric commodities, much more limited. There is a certain amount of Malaysian palm oil, and you can't take $100 billion and say, I'm going to be mainly a Malaysian palm oil. But can you add a little bit at the margin and do that in 50 other commodities? Yeah. So we've, again, I don't think this was a response to that tough 2 years. But it did coincide at the same time. So I do think we got better at a whole bunch of things.
I have to ask you about some of the hot topics of the day because you play in so many liquid markets. What do you think about this massive fascination behind private markets? We all know that you think a lot of it is volatility laundering, but
That's
what
a
else?
Great phrase. Who came up with that phrase?
I wonder.
People exaggerate my mad on for privates. I invest in privates. I think they're a very reasonable thing. I think a lot of people who do privates are probably the best investors I've ever met in terms of understanding a company. There are people who argue, any investment you can think of as top line, what do you make, the average return, and what is the risk? And you can argue about how to measure risk, but just think of those concepts. The top line is argued about. Do you have to be in the top quartile of private investors? If you buy one of each, what do you make? Is it better? Is it worse? And people fight about IRRs and how to measure that. It's not my fight. The numerator, how risky they are, is where I have gotten my back up a few times. And a lot of people in the private world get this entirely right and are entirely honest about it. They'll tell you, we don't market to market, but we're 1.3 times levered equities, and it's equity-like risk in any medium to long term that matters, and zero problem with that. Every once in a while, and people now send these to me just to rile me up, which, by the way, is an exceedingly easy task. But they'll send me things like a tear sheet for a private fund that at the bottom has Sharpe ratio, realized Sharpe ratio, 10.0. And this actually happened, and it was actually 0.0. I thought that was a nice touch, right? Not 10.2, 10.0. And that'll create smoke out of my ears, and unfortunately, anyone can tell if I'm angry because my entire head turns red. Sadly just passed, incredible man, but Jim Simons, he didn't have a 10 Sharpe ratio on his best day, and was probably the greatest money machine we've seen ever. So when I see a 10 Sharpe ratio, I think, you're doing something wrong here. So I have zero problem with them as investments. I do think it is very dangerous to misestimate the risk, because some people get it and will allocate an amount saying, yeah, we know what they say 10, but it's risky, and we think they're levered, and we know what credit does, and if we have a 5-year bad period, we know we're going to get creamed. Fine. But for the people out there, and I think there is a subset, I don't want to, you know who you are out there. People draw efficient frontiers and put private credit way on the left at like 1.5% vol. If you're actually building your portfolio believing that, I think you're building a bad portfolio. So yeah, I have a problem with some subset of the market that grossly understates the risk and kind of believes it or acts like they believe it.
We are at time. We have to leave it there. Cliff, thank you so much for your time today.
Thank you, guys.
I'm halfway there. I have a competition with myself. look out for it. And thank you guys.
Please welcome to the stage Sean Ginnivan, the head of Global Technology Partnerships at Android Enterprise.
So good afternoon. I'm sure a lot of you are scratching your heads asking, what is this guy from Google who works on mobile technology doing at an investor conference? And what is the whole session going to be about? It's a good question. One of the things we've done at Google is really start to look at how are technology tools meeting the needs of financial services professionals. And we decided one area we would look at is mobile specifically. And when we looked at data, we surveyed a bunch of bankers and folks in the financial services industry, and we asked, what are you able to do with your mobile device? We found out that most people are basically doing with their mobile device what they did with their BlackBerry when it was first introduced to the market 25 years ago. Less than half of folks said they had access to internal applications. Less than half of folks said they could use their mobile device to help with selling data. Less than half of folks said they could go and use their mobile device to look up organizational information. And I think that becomes a challenge in today's markets. We talked a lot about this, this morning and this afternoon about market uncertainty. I don't need to go and educate you about that. But certainly we know that the need to go through and understand information in real time has never been more critical. The ability to go through and react to market events and understand what's happening and make a decision has never been more critical. And simultaneously, we have this emergence around generative AI. Quick show of hands, anybody heard of generative AI? Well, at least not to nods. I'll wait for the hands to go up later. But the point here is that these tools, the ability to go through and analyze massive amounts of data and make decisions has never been easier. The challenge that we have to ask ourselves is, do we want to go through and make all those decisions directly from our desk, directly from our laptop PC? And the other thing that we're sort of seeing is shadow IT lurks ahead. We've often seen cases where employees, in an effort to be productive, take matters into their own hands, irrespective of some of the costs that might cost the organization. Now, one of the things that I've seen, and I was very honored to attend a panel with Mary Daly, who's chairwoman of the San Francisco Fed, and she said that technology doesn't make decisions, people make decisions. So the challenge we have to ask ourselves is, are we arming people in a world where most people are still using mobile as a technology to answer email with? Are we arming people with the right tools they need to go and be productive? I would argue that mobility has been never more critical to meet the needs of financial professionals. At the end of the day, mobility is the presentation layer to all these wonderful AI tools that are being rolled out across your organization. If we truly believe that people are still at the inherent forefront of all the processes running in organizations, we have to enable them to be able to go and make those decisions on the fly. And so I would echo Chairman Daly's point that mobile is really a core way that data becomes actionable by people. And I think the good news here is that the new class of mobile devices that are reaching the market really allow people to go and interact with mobile applications and mobile experiences in a fundamentally different way than maybe the phone that is sitting inside of your pocket today here at the Bloomberg Invest event. It allows you to actually unlock new productivity. The foldable devices we're showing outside allow you to go through and run applications side by side. The ability to go through and, for instance, pop up an email and simultaneously redline a document. The ability to go through and open up enough screen real estate to dive into particular indices, really understanding what that graph means versus seeing something about yay big. And even going through and being able to go through and work across applications. So being able to go through and take a document, open it up into my e-signature application, and send it off for signature, or open up a document and edit it out on the fly. Now, these experiences are being built by some of your favorite developers. I've had multiple people ask me today if Microsoft Office is supported, and I'm excited to say yes. But also partners like DocuSign, SAP, Zoom have all been going and building applications that can immersively move from an at-a-glance view and a folded viewpoint into a rich, detailed view when the device is unfolded. And certainly one of the application developers we've been really proud to work with has been Bloomberg, and we're showing some of those new experiences with the Bloomberg Professional application outside. Now, Generative AI has been talked about a handful of times at today's presentations. Certainly, generative AI is also coming to mobile devices as well. The ability to go through and record a conversation on my Pixel device, automatically generate a transcript of that presentation is something that AI has done for quite some time. But now with generative AI, I can take that text transcript and automatically build meeting notes on it. And because all of this work is being done directly on the device, we don't have to worry about what service in some random cloud somewhere out there in the world is going and processing that data for me. Gemini is Google's large language model. You might have heard of it, but it is our approach to generative AI. It ranges from a small model that can run locally on a mobile device all the way out to a large cloud-based model that can handle not just text, but images, video, audio, and even application code as well. Now, we've all gone and seen the challenges. I talked about this idea of shadow IT. The challenge that lurks ahead is that people are already out there in front, inside of your organization, deciding how they're going to be productive. In a recent survey from Cisco, 48% of folks say they've already logged non-public proprietary information into generative AI tools. And that's in a world where 27% of organizations say they've banned Gen AI, and 63% say they have controls about what data is allowed to be put inside of those systems. We've seen this movie before when a bunch of folks decided that they didn't have the right digital communications tools, and they turned to WhatsApp. It creates a massive amount of regulatory risk, and now is really the time to be thinking about how are we going to enable our employees effectively? How are we going to put the right tools in their pocket and allow them to make those right time decisions? If you're curious to learn more, a lot of us from Bloomberg and Google are outside. We're also running a session later today at 5 o'clock where we'll be talking about some of the new experiences that Bloomberg and Google have been working on together. Thank you for the time and attention, and looking forward to talking to more of you here at this afternoon's talk.
Please welcome to the stage Sarah Malik, Chief Investment Officer at Nuveen, and Mohammed Al-Suwaidi, Chief Investment Officer Region Americas at Qatar Investment Authority, with Bloomberg's Matthew Miller.
All right, this is very cool. I'm excited for this panel. We have a lot of great stuff to talk about, but it's also really interesting to get the take of a CIO and an investor, very active investor at that. So I want to kick off by, I watched Sarah this morning on Bloomberg Surveillance, and she was talking about 3 factors that are going to drive the market, important factors. And I looked at those, and I thought that's really a great way to have a conversation about the markets right now. AI is one of them. The consumer is another. Elections are the third. But I think each one of those opens up a really interesting conversation. So why don't we start with the first one? And I'll start by asking Mohammed, since you contribute the factors, I'll get Mohammed's take on, you're a very long-term investor. You're offering an enormous amount of capital to global markets. I'd love to get your take on AI. Is it just, the flavor of the year? Or is it something that's really going to drive us, like the internet has, long-term over decades?
It's a great question in a time where there is a lot of buzz about it. But fundamentally, all businesses need to be more efficient. And one of the ways to make human more efficient in their procedures and make companies and make software more efficient is empowering it with AI. The key fundamental thing that happens is the strength of software coped with and coupled with the strength of hardware, which is available now. And that opening up and the availability of data, those 3 factors getting together and proof of concepts flowing in indicated that there is a big use cases across the industries. We believe it's a very real thing. In fact, we in QIA, we're a very long-term investor, very sizable as well. From time to time, we assess the long-term themes that we should spend time on, and AI was one of them a few years ago. We started investing heavily in things like data centers. So in addition to investing on highly volatile or kind of higher risk return businesses that we really like to invest in, we do a lot of investments in those as well. But you could also invest in a lot of things that are more infrastructure-like and would fuel AI.
So, Sarah, how do you look at it? I mean, obviously, we all think about the end user, but also Mohammed is one of the large investors that's going to drive this sector. When you look at it as a CIO, what do you find interesting in terms of, industries that it's going to affect? Software, hardware, where do you look to put money to work?
Well, beyond the traditional AI plays, the other thing about AI is that it works off a ton of data. So these large industries like healthcare, financial services, R&D in healthcare, where there's tons of data, financial services investors like us who can look at our trading data and our client data and use AI to make us more productive and more solutions-oriented for our clients. I think it's going to be important across a host of broad industries, but like any newish sector, it has its fits and starts. So you've had this period since February 2023 where if we go back and think about that, everyone was worried about a recession last year, and instead we got February 2023 where AI became more widespread and the markets took off. So we've had that period of sort of euphoria, very limited supply of stocks. NVIDIA, Microsoft, not a ton of companies that we can invest in publicly. That's why those stocks have done so well. And now we're seeing a bit of a consolidation phase. You look at NVIDIA, which has been down over 10% in the past few days. But as I mentioned this morning, we're just back at early July price levels for NVIDIA. So this isn't exactly a massive downturn for the stock. But there will be these periods of consolidation where it gets somewhat overbought, but the long-term trends for artificial intelligence, that increase of productivity and revenue boost for companies, I think is here to stay.
Yeah, $430 billion in market cap was wiped out over the last 3 days. I think it's still up. It was up at least when I left the office an hour ago. In terms of the investment opportunities, are you finding more, Mohammed? Because as Sarah mentioned, at least in public markets, there are only a few, as you can see by the capital formation, there are only a few opportunities that investors can go to.
To add to another point, actually, not necessarily the new market cap created is a new opportunities. A lot of that is actually new players eating up legacy existing players. So to answer your question, I think, first of all, we as a long-term institution, we're conducting constantly deep reviews on what kind of businesses we own that could be negatively impacted by the long-term new themes as we see them. So one is looking into how could we readjust our portfolio and mitigate it against some of those themes. AI is one of them. In terms of availability of options, there is the public space where there is few names really that address them directly. But in the private space and some of the public space as well, you find very interesting applications where it's AI empowered. For example, we invested in a business called Radiology Partners. It's basically a medical services business that utilizes AI to make radiology assessments better. For example, it's seen that radiologists, there's not a lot of them, sometimes difficult to find a radiologist on time. So having some software that enables you to aggregate all the know-how and data historical and utilize and make radiologists be able to see 20 scans in an hour instead of being able to see 4, for example. So in addition to finding new hardcore AI, we're looking into other applications that could be empowered by opportunities or businesses that could be transformed with an element of AI.
It's interesting. An interesting tangent to this is public investments versus private. And last year when AI really took off, we also saw an explosion in interest, at least, in private investments, certainly in private credit, even for retail investors. I talked to a guy who was running a platform that was going to allow retail investors to invest in private credit. I thought maybe that's a little bit above their pay grade, but it's happening, right? How do you look at the asset allocation between private and credit in portfolio construction?
Sure. Well, I think the 60-40 equity fixed income portfolio will evolve to a 50-30-20, 50 equity, 30 fixed income, 20% alternatives. Alternatives provide not only lack of correlation with other asset classes, but more diversification from the other asset classes. I think 3 asset classes and alternatives are very interesting: farmland, infrastructure, and private credit. So first, starting with farmland, it's a great inflation hedge. Over the past 30 years, on an annualized basis, land has outperformed inflation by 8.5%. Obviously, a key issue these days with inflation staying sticky. Looking at infrastructure, not only the tailwind from building additional data centers and different ways to meet our AI needs, but also the shift to renewables. Estimates show we'll be spending $200 to $500 billion a year on electrification of our grids, also increasing our grids by over about 50% over a number of years in order to meet the demand for renewable energy. And finally, onshoring of all kinds of supply chain as the U.S. relies less on other areas of the world. So infrastructure is a multi-year play in alternatives, public and private infrastructure. And then private credit, another area where investors are looking because it's been more resilient in economic downturns. And also people sometimes push back on, what's really going on with private credit? What's the quality there? Is it just a lagging asset class, that'll just catch up with high interest rates and we'll run into problems? We're not seeing that in the data at this point. So private credit still looks very resilient to us.
Mohammed, your remit is the Americas, but you also are the second highest ranking member on the investment committee, so you're overlooking the whole global portfolio. Give us the 30,000-foot view of your portfolio.
The good thing about us is we have only one customer, which is the state. So when you have one customer, you don't necessarily need to be super open in terms of your allocation policies. But to give you a sense, about half of the book is in the public space. And the other half is more kind of privately held positions, including things like real estate and infrastructure and alternative. We like this combination because we'd like to play to our advantage of being able to extract more illiquidity premium, and we take a little bit, occasionally, more execution risk and development risks, and having a sizable exposure into the private space enables us to do so. Over the past few years, we tactically increased our exposure into credit. It was an interesting time for us to do more on the credit, in a time where private markets were a bit shut. And we still see more opportunities in the private credit space, despite because the banking system is in a complicated position and continues to be.
Clearly you have a very long investment window, but what are we talking about? 5, 10 years, or even further out?
The fund has, by design, the state does not require us to bring back immediate cash flow. So the immediate outflows expected from us is 2030 plus, and it's a systematic dividend back to the state. This enables us to kind of plan for longer term. However, every investments we do, we have a time frame attached to it. We have annual assessments to every investment, and then we kind of ideally would probably underwrite a 5 to 7 years, what we consider long term. We could extend if we believe that reinvesting, there is no available reinvestments of same quality. So we could easily extend that time horizon to much longer.
I want to talk about
enables us enable us to allocate to strategies such as growth equity, technology, and healthcare, which could be much longer than 7 years. But we believe that if we underwrite it and we invest in the human capital and have the right investment teams, it's justified to stay longer and enables you to get better multiple return and better return metrics over the long term.
I want to talk about the consumer, and it's interesting because you can look at the consumer. I normally do sort of at a medium term, right? But Mohammed, you're looking at these issues over a much longer term. Sarah, you mentioned consumer weakness as one of the drivers of the market right now, and of course, we've seen since the pandemic, certainly most consumers spending all of the stimulus money they got, driving down the savings that they have, and now the lower two quintiles at least seem to be struggling. We even hear reports of wealthier consumers, switching down from, say, Whole Foods, for example, to Walmart. That was in Walmart's earnings report recently. And the last couple of days, we've had reports of Winnebago not meeting their sales forecast, pool installation not nearly as high as the largest pool distributor had expected. So what do you see in terms of the consumer weakness right now, and how long do you think that lasts?
Well, sure, there's 3 factors that we're looking at for the second half of this year, and that's the economy, elections, and earnings. So the first one, in the economy, 2 factors in there that are important. That's the consumer and employment markets, because those have been some of the key drivers for this economic cycle. We are seeing cracks with the consumer, not only an increase in delinquencies, fast food restaurants discounting Retailer foot traffic, weaker. Retail sales has been missing estimates for the majority of this year. I think consumer is starting to slow. Employment markets have been mixed. Payroll data has been strong, but if you look at other data points for the employment markets, they've been becoming weaker. You look at unemployment claims, they're almost at highs for this cycle. So we are seeing employment markets start to slow. Usually people are more comfortable spending when they're comfortably employed, so those kind of go together, and I think that would be what brings us into a recession at some point. I think a recession is a when, not an if at this point, but it's not going to happen immediately. So it'll take some time, but we are slowly getting there. Elections is another key driver for the second half of this year. Huge year for elections around the world. 77 countries, 60% of GDP going to the polls. We've already seen volatility from South Africa to India to France and other key non-U.S. markets. In the U.S., of course, we're pushing the second half election. Good news, though, is even though volatility picks up in an election year, markets actually tend to perform well, which is what we're seeing. And third is earnings. Earnings are the key driver for the markets. We're just approaching second quarter earnings, and they look strong. So that's also the good news. Earnings should be up from a consensus point of view, a little bit over 10% for the second quarter. So news is good now. I am more concerned about the medium term, though, as the consumer slows, as the job market slows. I think we will slowly move to recession. A key question, of course, is will the Fed save us or not? I think it's a tough balance for them.
Well, you know what I thought was interesting? Michelle Bowman from the Federal Reserve was speaking in London either last night or this morning. I saw the news on the Bloomberg this morning. And she was saying that restrictive immigration policies could strengthen the labor market, right? Because we've had such an influx of immigration that there's been so much supply in terms of labor. And I immediately thought about your election volatility, right? Because one presidential candidate is likely to restrict immigration more than the other. Is that a game changer? Do you think that could, change the way the U.S. economy actually goes, the November election?
I think what's been challenging about the labor market post-COVID is there's been so many factors that have caused it to behave the way that it has. So where participation rate has been weaker than we wanted it to be. Older workers have not come back into the labor force. We don't know. People talk about immigration. How does that impact? I go back. I think there's so many factors that have confused people with this labor market. It's hard to point to one. If you look at the presidential election in general, what earnings are going to drive the markets. While we usually see volatility going into the presidential election, usually the markets calm down afterwards, especially if the outcome is gridlock. And then sort of the president will have sort of less government impact on the markets and more fundamental impact for the markets, which is a positive for investors.
Mohammed, you can look at obviously the labor market the way we're talking about it right now is too short term for your investment horizon. But if I think of a longer term consumer trend, I think of India right away as a rising, growing middle class. How do you look at the consumer globally?
There's globally and there is regional. So in addition to the middle class rising into a lot of major markets, a lot of developed markets as well, you also have generational changes of the way we consume. So compared to 20 years ago, the style of consumption now is a bit different, and compared to 50 years ago, it's started quite different. And I think there was a little bit on excess boost post-COVID, where people started now putting much more on services than they're doing goods. And in goods, people are focusing a lot on things fueled a little bit by things like social media and what kind of the consumer behavior is focusing on, like lifestyle and things around healthier consumption, a lot of the trends. So in addition to your point of middle class, and there is some other more fundamental generational trends that are happening.
Ozempic. By the way,
one of them. I think that the market cap of the business is getting quite well, so there's a lot of users around town. So all those kind of consumer behavior is just changing. So in addition to a weaker consumer now, as we see interest rates, you also have generational changes that happen from time to time in the way we consume. Both has to be assessed at the same time.
How do you look at the U.S. consumer? And does, if we do get a continually softer labor market and inflation continues to trend down, how much does the Fed matter to you at the QIA? Like if they cut once or twice this year, does that matter?
I mean, it matters to any investor. This is the key fundamental driver for pricing and how you price assets. At the same point of time, the cost of interests the consumers would pay over the credit cards and various goods they acquire is quite different than it was 2 years ago. Now, I'm not suggesting what is better in terms of levels, I think the Fed did the right thing to kind of, the biggest enemy for us is inflation, which has come back significantly. Now it's that how long it's being kept. And you look in terms of the consumer quality, the strength of the consumer, you see a lot of fatigue, weaknesses. A lot of the indicators are around consumer quality and strength, whether it's in the credit card, the automotive, and a lot of the variables. So there's definitely a weaker consumer coupled with a strong labor market now. So as that become weaker, a little bit labor market, you would immediately should expect to see significant impact on consumer strength.
You expect, Sarah, a recession, as you said. You expect the Fed to cut rates initially in September, which, I think is interesting because it's right before the election, and the Fed, I think, wants to be less political or as apolitical as possible. Why do you think they'll do it in September, and will they be forced to continue cutting rates? Because that would be bad news for the market, right?
Well, the Fed tends to do less, not more in an election year for exactly the reason that you stated. We've said September at the earliest for interest rate cuts, and because what we need to see is we need to see multiple months of moderating inflation. We just saw probably our first month of CPI, missing estimates, PPI, coming in at or under consensus. And then, of course, this Friday we have PCE, so we'll see what that looks like. I think the Fed doesn't want to risk losing credibility by cutting rates too early, so the safer bet is that they stay on pause for a while longer, until they either see inflation start to moderate or the economy slow. And that's sort of the timing issue there. When will the economy really start to show more significant signs of weakness? So that'll probably determine your first rate cut. If it's not September, it's probably post the election, likely in December. Mohammed did bring up an interesting point on generational behaviors, and I think also another sort of important market trend is the trillions of dollars that's going to transfer from one generation to the next, how the next generation will be thinking about money, and also, of course, the trillions of dollars that's still sitting on the sidelines for people who were waiting for that recession in 2023, sitting in their T-bills, sitting in cash, earning 4 or 5%, that have now missed out on this rally and are figuring out how do I get back into the markets, particularly equities.
You'll be able to take, I heard Ed Ardeni recently say that the baby boomer generation has $75 trillion in household assets minus liabilities. It's massive. It's half of all of the U.S. household assets. You'll be able to take advantage of that. How do you think about that, Mohammed? Because that generational shift is going to be massive.
I think in addition, we are a significant investor on consumer businesses. We invest in travel and leisure businesses as well. So, we also invest in asset managers actually with time, and we've been investing a lot of the IRAs and been focusing on that as well. So there's a significant trend that we're trying to capture through investing in financial institutions. At the same time, businesses that would be net beneficiaries out of that consumer behavior.
I want to talk a little bit more about the election and how you see this. Sarah, Larry Summers thinks that Trump's policies will be the most inflationary that he's seen from any politician in his lifetime. I feel like Larry Summers was being a bit alarmist in that sense, because even though Trump's policies are going to be a different scale than Biden's, he still wants to put tariffs on China. He still wants to restrict immigration. So how concerned are you about the election?
I think it's shorter term. Of course, the election will cause volatility, but I think it's hard to pinpoint the cause of inflation on any one person or any one policy. Just post-COVID, the unwinding of supply chains has been inflationary. China, if it really starts to reopen and recover, that could be inflationary in terms of commodity prices. Onshoring closer to home will continue to be inflationary. And consumer spending has been inflationary, just people wanting to keep spending money. You mentioned the trillions of dollars that went to the consumer during the pandemic. So there's so many reasons that inflation will continue to be sticky. Also, just looking back at history, if you look at inflation prior to the GFC, going back about 50 years versus post the GFC through the pandemic, inflation was structurally much higher for the decades pre the GFC, and so were interest rates running sub 6%, a little below 6% for the 50 years pre the global financial crisis versus sub 1% post the global financial crisis. So, if you look at the normal world, higher interest rates and higher inflation were basically the norm. That's why I think it's here to stay, and I don't pinpoint it on one presidential policy or one factor continuing or not. I think it's just really we're going back to, I guess, not the new normal, but the old normal.
I want to finally ask you, Mohammed, what you think about the U.S. deficit from the QIA's point of view. I notice we're spending $100 billion a month now on interest rate servicing. So we're spending more on our debt than we spend on the military. It's going to be $1 trillion a year and start to eclipse that quickly. Does it bother you?
It definitely bothers all investors investing in the U.S. But I think we're assessing and thinking about it all the time, and all the investors the same thing. is that what is the solution? What fundamentally is changing in terms of how do you deal with the debt with time, and how do you deal also with the fiscal discipline across the various states within the U.S.? You see a lot of great cities need to be probably rethinking about their positioning on a global stance and within the U.S. itself. So it bothers. I don't have the solution, but I think with time is thinking about the actual long-term approach is super important, both in fiscal discipline and on dealing with the high level of debt.
All right. Well, unfortunately, we're out of time, but it was great talking to you both. Thanks so much, Sarah and Mohammed.
Thank you.
Please welcome to the stage Paul Taubman, founder, chairman, and CEO of PJT Partners with Bloomberg's Sonali Basak.
So for many of you who don't know, Paul Taubman is the founder of PJT, took it public 9 years ago now. Time flies. And of course, himself has worked on many of the largest deals the world has ever seen. PJT does a few things. It does capital advisory. It also does restructuring. It also does M&A. We might as well start on M&A because, of course, it's been an interesting market. And in the meantime, too, I want to pull up a poll for the audience here. This idea of which comes next? Which corner of the market is prime for M&A activity? And while you guys choose, it's a good time to ask you, what's going to come back, how fast and where?
Well, if you take a step back, COVID has disrupted everything. So when we look at the M&A market, I look at pre-COVID, 2019. So we're sitting here today with a market that's down 20% versus 2019. And the question is, why isn't it back to those levels? And I think it's two things. One is the regulatory scrutiny on transactions, particularly large transactions, is fundamentally different than it was 5 years ago in a different administration. And if you look at large transactions, sort of mega deals, they're down 50%. Until there's either a change in administration or this administration gets to a second term, I think a lot of deals that are being actively considered are just not going to be brought to the market. So we're going to see more transactions of large scale post the election than we've seen. And I think those are in economies and industries where there's the greatest dislocation. So I would certainly put media, healthcare, finance in that bucket. I think the second thing is interest rates where they are today have frozen a lot of transactions because we clearly have a cresting of rates, but until we see rates start to come down, I think private equity firms are trying to control exits. They're being far more disciplined about selling assets. As a result of that, they need to be more disciplined about committing new capital. And I think that engine really has been stuck. And what's going to change that is either a realization that it's higher for much longer, or we're going to start to see the travel back down on rates.
So what you said has a lot of ramifications because at the beginning of the year, many investment banks said they're green shoots. There are green shoots everywhere. Those green shoots are materializing into flowers finally. But it sounds like there could be a real hold through the rest of the year.
Well, we've never subscribed to that. So the good news is there's never been 3 down years in a row in terms of global M&A volume. We've had 2. I think we're quite confident there's not going to be 3. On the other hand, that first year of recovery tends to be reasonably anemic because it's a sclerotic environment right now, and it takes a while to get the transaction flywheel going. And one of the things that is underappreciated and underestimated, Sonali, is there's a bit of FOMO out there, which is M&A is pro-cyclical. If your competitor is making a strategic move, that tends to invite a response. And if your competitor is standing still, your comfort level in standing still remains a little bit higher. So we had always thought that this year might be up 10% plus or minus. It's tracking up 3 year to date. I don't suspect it's going to get a lot better this year, but I think what we are positioned for, as I said, is if we can get past this regulatory cloud And if we can get the direction of interest rates with greater clarity, then I think you're going to see a reasonably stuck M&A marketplace become unstuck.
Now, private equity, you mentioned it briefly. There's this sense that investors around the world have been giving to us that there is a sense of a liquidity crunch underneath the surface. Private equity firms are not selling assets at the pace they would have liked. They need that money back. They're unwilling to put new money in. What does that look like from where you're sitting?
Well, if you step way back, the alternative space has benefited from a nearly 2-decade environment where interest rates have been near zero. Those are aberrational environments, and then we've seen an almost unprecedented tightening, rate hike after rate hike after rate hike, and that has disrupted the alternative space. So we're sitting here today where a lot of private equity firms are not comfortable selling assets in an environment that's fundamentally different than the environment in which they underwrote the asset in the first place. And I like to say you can either buy assets in a low interest rate environment or a high interest rate environment, and you can sell assets in a low interest rate environment or a high interest rate environment. In that 2x2 matrix, 3 of those 4 are perfectly fine. The issue is when the asset was put on your books in a low interest rate environment and you try and sell it in a high interest rate environment, that's what creates the freezing. And what makes it even more difficult is private equity, which is an industry that has, by and large, built itself on the ability to control exits, and they have exquisite timing in controlling and finding the right market windows in which to monetize their investments. They're looking at investments put on in a fundamentally different interest rate environment. They see that an interest rate cut is just around the corner, or they believe it to be, and as a result, they have been very disciplined in lightening up and monetizing assets. And because of that, and because so much capital has been called and so much capital has been deployed, Shonali, in the last few years, that there is a very significant imbalance. And it's an imbalance if you've invested through the cycle, and it's an even greater imbalance if you're relatively new to the asset class, because the monetizations that are occurring, by and large, are from the 14, 15, 16, 17 vintages. So if you weren't there at the beginning, you're not even getting those distributions. You're out of whack in terms of your allocations, and as a result, that's made fundraising far more difficult for private equity firms, and it's made them far more judicious in deploying new capital. So you're seeing it in terms of supply. Private equity firms are being far more restrained in monetizing investments, and as a result, they're also being more restrained in new investments, and that's creating a lot of pressure on LPs, and that's why we're seeing a more vigorous desire on the part of LPs to sell and create liquidity within their LP stakes, and we're also seeing more interest on the part of GPs who are interested in finding liquidity mechanisms in individual portfolio companies.
Some of the words you used, freeze, significant imbalance. Ask more simply, how bad is it out there?
Well, ultimately, we get back to equilibrium. What we're finding right now is we're working our way through all of this. And it's just simply the sharp pivot from low interest rates to meaningfully higher interest rates. It's not that interest rates on an absolute basis are so high. It's that there's a meaningful delta between where those investments were made, at what interest rate environment there was, and the current interest rate environment. It's that delta that's creating the issue. And I think what you're seeing is GPs and LPs are finding other ways to create liquidity. GPs are slowing the pace of new investment. They're looking more deeply at ways to monetize existing investments. They're using dividend recapitalization opportunities, fund continuation vehicles, and the like. And we're slowly getting back into equilibrium. So it's not a crisis. It's just simply an imbalance. And it's an imbalance that explains in large part why the M&A market has been so sluggish to rebound, even though CEO confidence, consumer confidence, equity valuations, and the like all would be flashing green. And the reason we're more of an amber environment is because of that. and then leaven in a little bit of regulatory overlay, and it explains why we're off 20% from pre-COVID levels, and we're barely up from year-ago levels.
You know, it's interesting because if you think through for a minute just the pressure that LPs are under and you compound it with the uncertainty that's going on in the world, how are investors thinking through different uncertainties, whether it be the rising geopolitical tensions you're seeing in the Middle East or even the U.S. election here at home?
Well, look, I've believed for a long period of time that the volatility that we're likely to experience in the fall related to the U.S. elections is underappreciated. And I think, starting on Thursday evening, we're going to get people to focus on the fact that with early voting pulling things forward and with the debates moving things forward, that all of a sudden it's going to move from being on the side to being center stage. You then couple that with elections in France, what's going on in the UK and the like. It's clearly a turbulent time. But I think we're going to get past all of that, and it's an uncertainty that the market doesn't particularly appreciate in the U.S. I think they will. Clearly in France, investors reacted almost instantaneously to the snap elections. And I think it's just another issue that we need to work our way through. But there's always uncertainty in the world. The fundamentals of the macroeconomic backdrop still remain reasonably constructive. Companies are in changing dynamic worlds, and they recognize that they need to continue to reimagine their companies. And one way to do that is by committing capital, reallocating capital, changing the hand that they have. And as a result, I think people are getting on with it, but it's more complicated today than it might have been 5 years ago.
Now, as PJT, as an investment bank, you have a view that a lot of investment banks don't have because you also have a large restructuring business. You were talking about the private equity crunch, this idea that sometimes people have taken on debt to try to kick the can down the road. When does that all come home to roost? What does the restructuring pipeline look like?
Well, I don't know if it comes home to roost. It returns to normal, and maybe it overcorrects. Back to my earlier comment, we've had near zero interest rate environment for an extended period of time. That's the bubble. We're back in a more normalized world where capital is no longer free or nearly free. You are in a world where disruption and the pace of technological dislocation, it just speeds up. It doesn't slow down. Every year there are dozens, if not hundreds, of transformative, disruptive companies that are created. You can't have all of that creativity without having some roadkill on the side. You can't have an explosion in new technologies in terms of electrification, decarbonization, digitization, and the like, and have all of these new companies be brought up without others laid low. And I think what we're starting to see is rates going from near zero to more normal levels. We're seeing the quantum of debt continue to explode in terms of how much corporate and public debt is outstanding. We're dealing with the hangover effects from COVID, which severely hobbled many companies. We're seeing many industries be disrupted. And as a result, we expect that default rates and that the need to restructure credit agreements is going to increase appreciably. But again, not to levels that are concerning from a historic perspective, but back to more traditional levels. And I think that's very constructive for our business. I think people have been overly complacent. You see that in credit agreements that in many respects give borrowers a tremendous amount of freedom. They're using that right now to create more runway for themselves. And as a result, it's a companion piece. So I see a world where there's more active M&A, but there's also more active liability management.
Another thing different about you than many of the people that spoke today is you built your own business. You're an entrepreneur, you're a founder, you're almost 10 years into your business. I had covered PJT since it went public, and you made decisions. You made decisions to buy certain assets, get in certain businesses. You started from scratch, essentially. When you look at PJT over the next 10 years, what are the businesses? What are the things that you think PJT can become in addition to what you are now?
Well, first of all, I'm the accidental entrepreneur. I don't think I grew up or at any time in my career thought that I would be sitting here having helped to build this business. But we're incredibly proud of what we've built. I think we're just getting started. We have extraordinary ambitions to create the world's best investment bank, but we have the self-awareness to understand that in order to do that, you need to be extraordinarily patient. And you can't do it in a day, you can't do it in a year, you can't do it in 10 years, but you can be on this journey to build the world's best investment bank. And if it's built around intellectual capital, you need to make sure that you have more intellectual capital than anyone else, and you need to have a culture that invites collaboration and to get people who have different perspectives, different backgrounds, different expertise to come together. And that's why almost everything we've done for the better part of a year has been related to building a unique culture that is all around the client, it's all around collaboration. And as we get more successful, we become more interesting to many people who are at larger firms who see the success we've had and want to be part of it. And we're also seeing that a lot of their clients are gently or not so gently nudging them to firms like ours. So 10 years from now, I expect that we will have more capabilities to follow our clients into more places. So it's important to us to have a perspective on debt markets, equity markets, strategic IR, shareholder engagement, corporate governance, geopolitical advice, and to just continue to expand the breadth of our capabilities so that what's relevant to the C-suite is something where we have cutting-edge capabilities. And it's a process, and we're trying to work through building out all of what we need.
It's interesting you're saying this about hiring as well in this environment, because you think back to the global financial crisis, post-GFC, boutique investment banks started to pop up, and the talent draw from the big banks was meaningful. How meaningful is it today?
I think that door was kicked wide open as a result of the financial crisis, and I don't think there's anything that can close that door. If you go back to the global financial crisis, I think the brand value of the big firms was de-emphasized. I think many of those firms found that they no longer had the same command in corporate world that they did previously. I think increasingly boards of directors and decision makers were focused on the brands of individual bankers and less about firms. The conversion to bank holding companies for some of the last remaining investment banks created more regulatory oversight and the like. And there was that door that was kicked wide open, and through that was an exodus of talent that migrated from large firms to smaller firms. And now you've got this flywheel going where the more talent is embedded in smaller firms, the more likely it is for clients to want to work with more focused firms where advice is the main event. The more success that smaller firms have, that then invites more interest in smaller firms. And I think we're at an inflection point where big firms and small firms will coexist, and there's always going to be different horses for courses. But I think what really has changed is that increasingly clients, sophisticated clients, are looking first to smaller advisory-focused firms, whereas 10 or 20 years ago, it was the reverse.
I'm curious about your ambitions in hiring as well. I've seen you really lean into the hiring market in the past year when a lot of firms have pulled back. How ambitious are you? Is this a matter of being greedy when others are fearful?
You've said it well. The reality is that in a bull M&A market where everyone is chock full of assignments and they've just committed to their clients to help them execute those transactions, the dislocations in leaving and abandoning one's clients to sit on the sidelines for 6 months and then join another firm, that's when the switching costs are greatest. So in a low velocity environment, which is what we've experienced in 22, 23, a bit of 24, is the environment where the switching costs are lowest. Now, it's more painful from an investment perspective because we're making our largest investments in a low velocity environment, which means our margins get temporarily compressed. But if we don't take that long-term perspective, we're not building a world-class firm. So we're leaning in because this is the environment that is bringing out the most talent. If I could wave a magic wand, the best talent would come in a bull market. It tends to come in a bear market.
Before I let you go, when you think about the opportunity set ahead for you, biggest worry, biggest opportunity?
Look, the biggest worry in a firm that's built on individuals is reputation. And we have to live it every single day. And we now have more than 1,000 of our colleagues. We all work together. We're all trying to do the right thing for clients. But every day, there's always, the concern that are we exporting, are we inculcating our culture into everyone who joins the firm? How do we make sure that what was special getting to 1,000 people gets to 2,000 people? How do we always maintain the mission criticality of client service? As you scale and get bigger, those become bigger challenges. So that's my biggest worry. The biggest opportunity is we're just getting started, which is we've put in place so much intellectual talent. We now have a robust track record. We're much better understood in the marketplace. But no matter how far we've come in 8 or 9 years, what gets me really excited is we're just getting started.
Cheers to the next 10 years. Paul, thank you so very much for your time.
Pleasure. Thank you.
Our thanks to Paul Taubman for closing out the first day of Bloomberg Invest. We have another day ahead of us. We have a lot more ahead. Thank you so much for joining us today. And huge thanks to all of our speakers and moderators today for such a great program. And another big thank you to our presenting sponsors, Android, Invesco QQQ, Mass Mutual, and Mubadala. Our supporting sponsor, Principal Asset Management, and our participating sponsor, Southern Company. We appreciate them for making this event possible. If you'd like more information from our sponsors, visit the Resources tab on the event website. And we're not done. We hope you can join us tomorrow for another day of Bloomberg Invest. We are back here at 8:45 a.m. sharp downstairs on the innovation stage, proudly sponsored by Invesco QQQ. Conversations right here starting at 10 a.m. with Josh Harris of 26 North and Michael Araghetti of Aries kicking off at 10 a.m. Boy, did we get everybody on this program. For those of you with us in person, please join us for networking, refreshments, and light bites downstairs. I know I could use a drink myself. And if you're registered to attend the Odd Lots live taping, proudly sponsored by Principal Asset Management this evening, that will start promptly at 5 p.m. If you haven't seen Joe and Tracy live, I would not want to miss that either. If you are registered to attend the exclusive preview session, proudly sponsored by Android, please make sure you start heading towards Hub 1, starting at 5 p.m. for check-in. And if you are signed up for the Martingale Cognac Destruction Tasting, very jealous of that, please head to the gallery area down the hall now. Have a wonderful evening. See you guys back here tomorrow. Thank you.